to today's webinar on Market Insight for Fixed Income, where we discuss what went by in the previous month and our outlook going forward. The MPC meeting for August concluded yesterday, wherein RBI maintained the policy rate unchanged at 6.5% and also retained the withdrawal of accommodation stance. RBI remained laser-focused on the inflation target of 4%, particularly amid persistent food inflation pressures. I am Sonal Mittal, Product Specialist at UTI Mutual Fund, and I am joined by our Head Fixed Income, Mr. Anurag Mittal, to share insights, perspectives, and outlook on the bond market. Post remarks from Anurag, we will take up question and answers. Please note, you can post your questions on the link provided to you anytime during the session. Without further ado, I will now hand over to Anurag. Over to you, Anurag.
Thank you, Sonal, and good day, everyone, and thanks for joining in on the UTI webinar. So before discussing RBI's MPC policy, we will just discuss the key global trends which are likely to shape up market behavior going ahead, and also RBI's reaction function possibly in the face of those. So as we can see on the left-hand side, which is the JP Morgan Global PMI chart, if we look at how global economic activity has panned out, and by the end of December 2022, both services as well as manufacturing had made a bottom. When we started the year 2023, there was an expectation that probably things will continue to deteriorate and probably central banks will have to cut rates. But as we can see, what really happened was that consumer who had been given a lot of stimulus during the period of COVID, which is 2020-21, their balance sheets were still intact. If you look at the supply chains, they normalized. It led to profitability for manufacturers and broadly led to revival in both manufacturing and services. That's the story of 2023. If we look at in 2024 as well, that's largely playing out in a similar fashion for the first half of the year, which has now led to a view that probably there will not be any hard landing. At most, there will be a growth slowdown from the current levels. And that's why central banks may not have to act much, or they may not have to act at all. I think, so if you look at the current, where the market stands, there is now a slightly downside risk built into the market expectations, because now, as market is now expecting status to continue, as we saw during the last week, any financial volatility can lead to meaningful decline in growth expectations, can lead to equity market volatility, bond market volatility, and most importantly, currency market volatility, which can lead to imbalances manifesting themselves in other areas as well, most importantly, banking. And hence, we will have to watch out for both these data points. We saw manufacturing services. If we look at even on the industrial production, both on advanced economies as well as on developed markets, industrial production is also going quite well. So we have to keep an eye out on how these activities are panning out going ahead as well to assess central bank monetary policy reaction. Coming to the commodity and food index, so as we can see on the left-hand side, which is the Bloomberg Commodity Index, it is at its 2024 low. As we can see, as commodity fell, month on month, it was a broad-based fall across oil, food prices, natural gas. The first reason was supply chain normalization. The second, of course, is, as we saw on the first slide as well, now market participants are getting concerned about the future growth trajectory as rates remain restrictive, and that's what's led to fall in commodity prices on a broad basis. It's also reflecting in increase in precious metals such as gold, which typically rallies in a period of easy monetary policy as a store of value. So that's what's really happening on the commodity side. If we see on the FAO food index, so as we can see in the chart, the food index made on a YOY basis went down sharply in somewhere in the middle of 2023. It was going up, but last month even the food prices started to fall as supply chains and weather patterns are looking more encouraging for food prices as well. If we look at inflation data, for most of the large global economies, inflation data is looking quite on the healthier side. As we can see, UK has already reached 2%, Eurozone 2.5, US is also 3%, but it's also slowing down meaningfully. The only outlier is Japan, which continues to see sticky inflation, and that's where we saw some pressure as well as market participants unwound some of the yen carry trades, which they typically carry out because of low yield status of Japanese yen, which now market participants are concerned that probably BOJ may have to hike more aggressively to contain this inflation, and probably it can lead to higher financial market volatility across major economies. If you look at the 10-year sovereign benchmark yield movement, as we can see across the major economies, there was a rally. If you look at US, there was a very sharp rally from 440 to 403. Same way, if we look at Brazil, for example, there was a rally of about 45 basis. If you look at even Asia, whether we look at Singapore rallying by 33 basis, India by 8 basis, Indonesia as well by 15 basis. As broadly now, there is a better visibility of inflation trends emerging, that inflation indeed is going down. Core inflation is also quite healthy. Growth is moderating. Overall, it's a good construct for central banks to cut rates, and that is what is reflecting in bond prices as well. If we turn to financial conditions, as we saw, turned tighter in the month of July. In fact, if you look at the fall, it's the last time financial conditions tightened so meaningfully was in October, when there were fears that Fed may continue even beyond 5.5 policy rate as well. Of course, it didn't materialize, and conditions became easier in the early part of 2024. But one of the reasons for this financial conditions index tightening was there was a volatility in equity markets on weak labor data in the US, which is leading to a section of market participants projecting probably a hard landing as financial conditions remain restrictive, interest rates remain restrictive. There is a section which believes that we could see for a hard landing because Federal Reserve has kept rates high for quite long. But it's still to be seen whether the actual economic activity is as weak as some section of market participants are projecting. Just to remind, this financial conditions is a summation of credit spreads, equity, market volatility, bond price, etc. So while bond yields and credit spreads are largely stable, it's the equity volatility in equity markets which led to tightening of financial conditions. If you look at the market implied policy rate forecast, so this is at the end of July, this was projecting about 75 basis of rate cut, as market participants now think that Fed will have to cut rates in all the three policies in the rest of the year to contain slowdown in economic growth. Coming to India, so the most important event yesterday was RBI monetary policy, where RBI kept policy rates unchanged at 6.5 and retained its stance of withdrawal of accommodation. So just as a background of the policy, largely if we look at where RBI was in June, RBI was quite clear in June that it needs to see hard evidence of inflation aligning towards the target of 4%, although which meant that it's not that they were looking for inflation to fall to 4% to cut rates, but they were looking for inflation to at least move towards the 4% target more durably to have a view of cutting rates. If we look at, in fact, the CPI estimates, in fact, RBI hiked their Q2 FY25 CPI estimate from 3.8 to 4.4 and Q3 4.6 to 4.7 because of intense heat wave this year, and we saw a huge spike in vegetable prices. So as inflation has actually gone higher than RBI's assessment in June, RBI rightly maintained its withdrawal of accommodation stance and kept its policy rate unchanged as well. There were two things that market was looking for from RBI. One was it's assessment of global volatility. Like I said in the beginning, there are concerns amongst market participants that probably U.S. economy could head towards a hard landing if Federal Reserve maintains rates tighter for a long time. It will people are looking at the labor market quite closely, and they believe that it is in a weak spot, and probably it could lead to a sharper than expected slowdown. So, and it could have repercussions on the rest of the world as well. So, there was a section of the market which probably was looking for a slightly dovish forward guidance from RBI, like more comfort from RBI on inflation as well as on growth. The second part uh, uh, or expectations from the RBI was its stance on liquidity. So as we know, on liquidity right now, it's running around 4 lakh crore surplus if you include the government cash balance. So, and given that RBI is in a withdrawal of accommodation mode, given that RBI has been doing OMO sales on the screen, it has done about 10,000 crores of bond sales in the month of July to suck out permanent liquidity of 10,000 crores. Market participants were slightly cautious that RBI may announce more liquidity absorption measures in the policy, which would have been negative for the bond as well as for the money market. And the second section of market participants were waiting for it to really give its assessment on how the global slowdown, if it happens, can affect India and what RBI was looking to do to contain it. But if you look at both the aspects, RBI played a very status quo policy where RBI maintained that they will do a combination of liquidity injection as well as absorption operations, which is called basically VRRR and VRR, which is variable rate reverse repo and variable rate repo options to fine tune liquidity operations to broadly ensure that policy rate of 6.5 is closely aligned to the overnight market rates. And secondly, on the global part, to give credit to RBI, the financial markets have been volatile for the last 1 year. So every 3-4 months there are some aspects in different parts of the world which come out, which leads to a lot of volatility. But broadly, it has been largely a smooth ride for real economic activity. And that's what RBI had acknowledged the June policy as well. RBI had said that global markets continue to be volatile, and we have to focus on domestic drivers, and we have to ensure that the inflation aligns to our 4% target. And that's what largely will help in case of any global volatility, apart from, of course, the strong FX reserves that India now enjoys. So broadly, the external credibility as well as internal focus on inflation and growth dynamics would lead to better standing and better interest from foreign investors, especially in a period of global volatility, and that's where RBI is focused at. So if you look at growth, broadly, RBI kept the growth estimate unchanged at 7.2% for FY25, and it also projected a 7.2% for FY26 first quarter. Given that RBI is projecting a 7% plus kind of a growth, we also believe that that's also driving their rate assessments and their rate actions. They don't see any issue in growth. They don't see any comfort on inflation. And that's why probably RBI wants either of these two to kind of correct, to take further rate action. RBI, if you remember last month in the June bulletin, had also forecasted that India's real rate, which is your policy rate minus inflation, has increased from 0.8 to 0.9% to 1.4 to 1.9%. And broadly, yesterday, RBI Deputy Governor Dr. Michael Patra confirmed that according to RBI, the current rates are close to neutral. That is, economy is neither growing slower than potential, neither it is growing higher than potential. And that's why we think that unless and until the RBI sees a sharper slowdown in growth or they get a higher comfort on inflation, they're unlikely to cut rates in the near term. On the other hand, if you look at global factors, such as possibilities of global slowdown, possibilities of global interest rate volatility affecting real economic activity, the chances of that have increased. If you look at most of the major economies such as China, Japan, now marginally US, economic activity is meaningfully slowing down. If you look at what we saw, commodity prices, they're also starting to slow down. So probably we believe that maybe by the last quarter of this calendar year, RBI should get better comfort on inflation and more clarity on the growth outlook. And that's what probably will give them some policy space to cut interest rates, although the interest rate cycles we believe are could be shallower because inflation, while it may get close to 4%, but it's unlikely that inflation will fall below 4%, barring a growth shock. And hence, we expect a 50 basis to 75 basis at most rate cut in this monetary policy cycle, given the current circumstances. We talked about inflation largely, as we can see, core inflation has been at its lowest in the series. It's almost close to 3%. If we look at even the CPI diffusion index, which basically depicts weight of constituents over 5%, that's also on the lower side since 2021 as well. So that's also showing that there are only few items which are experiencing inflation of over 5%. Most of the items in the CPI index are in fact experiencing inflation slightly on the lower side. So that should give comfort to RBI. So once these items also start to see some decline, some disinflation, it will give more comfort to RBI to ease interest rates. If you look at monsoon has also been quite encouraging. If we look at, for example, if you're seeing this chart at the end of June, in our previous webinar, monsoon was looking slightly negative than long period average. If you look at the sowing data, that was also looking slightly weaker. But if you look at the data as of end of July, there has been a sharp pickup in rainfall across India. If you look at on a pan-India basis, in fact, rainfalls are at the end of July with excess of more than 3%. And if you look at recent data, it's actually higher by 7% compared to its long period average. Especially, southern India and central India have seen very strong rainfall, whereas east and north region of India continue to see deficit rainfall. But if you look at the sowing data, that looks quite encouraging, especially if you look at pulses, oilseeds, sugarcane and paddy as well. They're all better or at similar levels compared to last year. So broadly, we do expect food inflation to slow down in the next 3 to 6 months, which should give some comfort to RBI. We talked about liquidity, how market was concerned that RBI may take some action on this very surplus liquidity. But as you can see, the headline liquidity has been around 1.5 lakh crores. And if you include the government cash balance of 2.5 lakh crores, the total liquidity is somewhere around 4 lakh crores. So it's quite comfortable. If you look at MIBOR, that's also quite close to the policy rate. The reason has been very strong government spending. So as we know, because of a long election cycle, the government was in model code of conduct, and it could not spend any meaningful amount on new capex, and that's why we saw spending also to be quite muted. But as elections have gotten over, government has started to spend, and that's largely led to liquidity improving. If you look at currency as well, typically the first 2-3 months of a fiscal year are a period of currency leakage, but typically that starts to come back into the system again to go back out in the festival season around Diwali. So broadly, this is seasonally a time of surplus positive liquidity. This is seasonally a time of currency coming back into the system. So broadly, it is a constructive time for money market segment. If we look at the credit growth, as we can see, non-food credit bounced back to 15.5% from 13.9% in June. There was a section of the market participants which were probably looking at June data to see that finally, the actions taken by RBI are bearing fruit, but we are again seeing some pickup in credit growth. So we need to see maybe for a couple of more data points on how this credit growth, especially on the unsecured side, is looking. If you look at unsecured loan growth, that actually deaccelerated from 18.7 to 14.8%. So broadly, we are seeing benefits of RBI action on unsecured personal loans. So, which is overall good for our, our macroeconomy and financial stability perspective. If you look at the fiscal trends, again, like we discussed about, the code of conduct leading to, lower spending, especially in the month of April, June. That's what largely panned out. But if we look at, in the month of June, the fiscal deficit was slightly higher as the government had to clear the expenditure backlog of April and May as well. But more importantly, if you look at the tax collections for the quarter of June 2024 were quite robust. If we look at the direct tax collection, they were up 22%, and even indirect taxes were up about 5%. And if you look at the net tax revenue, they're overall growing by 7% over last year. So overall, seems like a good comeback from the tax collections. We should not take too much into account from the capital expenditure in the month of June 24. So as we can see, there was a sharp fall of 65% in the capital expenditure, again, because of the code of conduct. But as government continues to spend, probably that capital expenditure growth will also increase going ahead. Coming to the trade deficit numbers had moderated largely, as if you can see, one of the main reasons was the moderation in oil imports. So oil imports moved from $19.9 billion in month of May to 15.1 as oil prices fell. It's the same similar, playbook which we saw in the commodity index that we saw earlier. So broadly, as the month of June was overall constructive for commodities, that also benefited our trade account in June. Broadly, we expect CAD to slightly widen from FY24 levels, but remain below 1% of the GDP for FY25, which is quite manageable. As you know, we are experiencing very high FPI flows due to the JP Morgan bond index inclusion, as well as FDIs are also expected to pick up as US central bank starts to cut rates. So broadly, we are looking at a healthy BOP surplus and a healthy rupee volatility going ahead as well. If you look at the sovereign yield curve, largely flat, but if you compare it to the month of June, it has started to steepen where the short to medium end has outperformed, the long end, largely as rate cut expectations have started to build on. If you look at, for example, even in this chart, the 10-year rallied from 701 to 693, but the rally was seen across the curve. There were two large reasons. One was the fiscal consolidation in the budget, but the second was more visibility on rate cuts globally as well as domestically. So if you see for example, the 5-year part of the curve, the 5-year GSEC fell from 672 to 685. So that's, kind of reflecting that steepening that typically happens at the beginning or towards the beginning of the rate cut cycle. That's largely which is playing out in the bond market as well. For example, if you look at the 5-year AAA, that's almost down by about 18 basis points compared to 10-year AAA, which is down by about 13 basis points. So yes, the 3 to 5 year segment has started to perform as we get closer to the rate cut cycle, and as we get further closer, as we actually see rate cuts, we believe that 3 to 5 year segment can outperform the long end of the yield curve. So broadly, on the outlook, like we discussed, inflation is moderating across the world. It's moderating in commodities, it's moderating in food prices, and hence we should see inflation getting comfortable. Like I said, RBI has seen very high inflation for a long time, and they are rightfully waiting for actual inflation to fall within their projections, and probably that is when they will be in a position to cut interest rates. Also on the growth part, the global growth drivers have started to moderate, although India so far has been quite different, as it's really driven by public capex rather than by private consumption, which is expected to be quite stable. Nevertheless, the export growth for India can moderate. The overall sentiment also can slightly weaken, which can lead to growth expectations also going down, and that's where we expect RBI to intervene. If you look at why we expect the yield curve to steepen, one, like we discussed when we were discussing the liquidity chart, typically it's a more constructive time for liquidity. Currency usually is coming back into the banking system. Credit growth is slightly moderate. We already saw unsecured loan growth moderating, and hence we expect even bank CD issuance to remain stable, and we should also benefit the 3 to 5 year part of the yield curve. The second point being that if you look at the supply calendar for government bonds as well as for STLs, it was quite lighter in the H1 of FY25 because of the elections, and we are expecting a heavier H2 supply calendar for both government bonds and STLs, and which should lead to underperformance of long end of the yield curve. Thirdly, if you look at the flow demand from FPIs due to JP Morgan bond index inclusion, it's largely in the 5 to 10 year part of the yield curve. In fact, RBI has removed the 40-year and the 30-year government bonds from the FAR index, which should lead to higher demand in the 5 to 10 year, which also makes sense if you're looking for steepening of the yield curve. And like I said, now there is a better visibility on monetary easing. Typically, yield curves tend to steepen when there is a stronger view on monetary easing, as market participants expect overnight rates to go down, which lead to rally in short-term rates as well. So broadly, to summarize, given that we expect rate cuts of only 50 to 75 basis, so we are expecting a shallow rate cut cycle. We are expecting liquidity to remain easy. We are expecting index-related flow also to be in the moderate duration segment. And now, as we approach stronger visibility on monetary easing, we think moderate duration products such as short-term corporate bond funds, etc., provide a better risk reward in this scenario. Of course, investors who have a horizon of 6 to 12 months can consider allocation to low duration money market strategies. If you see the gap between overnight and money market rates, that's also opened up quite meaningfully. So investors who are looking for a slightly shorter duration and lower interest rate risk can consider these strategies. Investors who have more than 12 months investment horizon can consider allocation towards moderate duration strategies. So that was broadly from my side. We'll open up the floor to questions. Please feel free to raise your queries on RBI policy or any of the aspects which we discussed in the webinar. Thank you.
Thank you, Anurag, for your insightful presentation. As Anurag mentioned, the webinar is now open for question and answer. While we wait for the questions to queue up, let me begin with the questions we have already received. The first question goes like, the RBI governor noted that several central banks are cautiously moving towards policy pivots through forward guidance and rate cuts. At the same time, there has been tightening by few central banks globally. Bank of England recently made its first interest rate cut in over 4 years. ECB is expected to rate cut in its September meeting by almost 0.5 percentage points is what the market is expecting. Fed is also expected to cut rates in the next month meeting. So do you see any concerns for Indian economy because of these global developments? Anurag, you're on mute.
Monetary policy divergence is not really a new theme which has emerged in the last 2 years. Largely, inflation is also a local issue because of certain supply chain dynamics play out differently in different economies. I think what RBI was trying to allude to, if I could guess what RBI was trying to say, was that yes, there are central banks in many parts of the world which are cutting because inflation conditions there have become more benign. But at the same time, inflation conditions are not benign across the world. And there are also central banks which are hiking. So if you look at RBI, what RBI is saying that we really don't have a growth problem locally. And we are yet to see inflation moving sustainably towards 4%. And hence, we should not worry too much about what Federal Reserve is doing or what Bank of England is doing or any of the central bank is doing. We should focus on the domestic drivers. And the domestic drivers are quite positive from growth perspective, and hence we can keep rates where they are. So it's not really about what can lead to global volatility. The global volatility is largely driven by one slowdown, which was probably expected to happen a year back, but it got delayed because of still a strong fiscal response from some major economies, as well as easier monetary policy conditions. As those conditions are getting unwound, as those fiscal stimulus effects are getting depleted, the growth is now giving back. It's a cyclical slowdown. I mean, we saw a strong cycle of strong growth. We could see some cycle of slowdown as well. So I think that's largely what RBI was trying to allude to.
Sure, Anurag. My next question is on liquidity coverage ratio changes recently by the RBI. So what do you see would be the impact of these changes?
Right. Thanks, Sonal, for the question. So largely what RBI also tried to say yesterday was that it's a draft guideline. It's not being implemented. And as they get the feedback from the banks and from general market, they are looking to modify the proposals as well. But assuming the proposals which are mentioned in the draft guidelines go through as they are, it can lead to significant demand in the shorter end of the yield curve as banks' LCR ratios on an average, because some banks may have a higher weightage and some banks may have lower, but broadly, banks may see at an aggregate reduction in LCR of about 10%, and that can lead to huge demand, especially on the 3 to 5 year part of the yield curve, especially on the government bond side, because government bonds are treated as HQLA. So, it can in fact aid in further steepening of the yield curve where the 3 to 5 year segment outperforms. But like I said, it's a draft guideline, so we need to wait and watch for the actual final regulations to take an assessment.
Thanks. Anurag, can you share your views on the attractiveness of floating rate bonds in current market scenario as we are heading towards a rate cut in the near future?
Right. So, like we have even I think previous forums discussed before, largely there are two components to floating rate bond for an investor. One is the interest rate, which gets reset as per the coupon, as per the benchmark. It could be linked to T-bill, it could be linked to MIBOR. Floating rate bonds, let's say, for example, government bonds are linked to 6-month T-bill. So as interest rates, ease, 6-month T-bill rates should also come down, and hence the coupon component of those bonds should also come down. Second is the impact due to duration. Typically, in a rising interest rate market, since participants are expecting coupon rates to go up, there is more demand for floating rate bonds, and they tend to do well. Similarly, in a declining interest rate and also in an easy liquidity environment, investors typically don't prefer floating rate bonds because there is a reinvestment risk associated with those bonds. And hence, apart from lower coupon, one is also subject to lower MTM, or you can say some MTM volatility or mark-to-market volatility in floating rate position as well. So not only an investor is exposed to lower interest rate or lower reinvestment risk, an investor is also exposed to some mark-to-market loss as well. So that's what we believe should an investor should keep in mind while allocating to floating rate bonds in a reducing interest rate environment.
Thank you. Also, we would like to have your views on state development loans. How attractive are they? And considering, in the budget also government had provided some support to the states. So what is your view on SDLs at this time?
So broadly, our view on duration has been constructive because, of course, we are expecting a rate cutting cycle. So SDLs also we do expect that they will participate. The only aspect that investors need to keep in mind that the best way to play SDL is probably through index related to SDLs because in a normal fund SDLs may be very small portion. So probably it's best to play them through a target maturity SDL fund or a pure SDL fund rather than looking through gilt funds which may or may not have SDL allocation. On the overall valuation part, probably in the next 3 to 4 months as SDL supply increases, we may see some spread widening in SDLs compared to similar maturity government bonds. And that's where probably investors then need to invest in these funds from at least a 1 year perspective, because there could be some near-term mark-to-market volatility which investors may experience in SDLs.
Sure. In the interest of time, please allow me to take 2 more questions.
Sure.
In the last week, demand concerns from China was keeping crude prices under pressure. Since last Friday, the weak US job data and yen carry trade unwinding that led to steep fall in the oil prices. Now, fuel demand in China has been weakening on the back of lower construction activity. However, fears of this escalation in the Middle East that continues to run, and it may lead to further increase in the oil prices. So what are your views on this?
So like you rightly summarized, oil prices are being there are a lot of pulls and pushes towards the oil price. At one side, there is weaker demand from China. There's fears of slowdown in the US as well, which is leading to lower oil prices. At the same time, there are fears of escalations in the Middle East. So to summarize, if you really see, the Middle East is already in escalation since October of last year, where there has been dispute between Israel and some of the other Middle Eastern economies. So probably we'll have to wait and watch out for that how this escalation pans out, whether it's a limited escalation at certain friction points or it leads to a full-blown war. Of course, if it leads to a very wide conflict and involving more economies, then it may lead to oil prices going up. But if it remains a regional friction, then probably it may not affect oil prices materially, and oil prices will follow what every other commodity in the world follows, which is the supply and demand, and that should largely take things forward.
My last question is, the economic survey has suggested that inflation target should exclude food prices. For years, when India was suffering high inflationary pressures that distorted financial behavior of people, the argument was that monetary policy is not the right tool to control food inflation. So what is your view on this?
So I think there was a lot of debate when India was selecting its inflation target. So as we remember, the inflation target formally was only introduced in 2016. At the time, RBI had done an extensive study that which target should they take? Should they take headline inflation or should they take core inflation? So for example, although US does not have an explicit defined target, but they do follow core inflation. Many economies follow headline inflation. Largely the conclusion from RBI study with headline inflation was that in India specifically, a large part of, in fact, core inflation is also formed by household inflation expectation. And typically, household inflation expectations are also formed by food price inflation rather than just core inflation. Given that food forms a large part of expenditure basket for majority of Indians. So although it is declining compared to last 10 years, but nevertheless it is on the higher side. And hence, if RBI has to ensure that it has to anchor inflationary expectations, it has to maintain a positive real rate over the headline inflation and not just core inflation. So this was, I think, already quite, I think, debated, discussed, and that is when the Indian Parliament, which can amend the RBI Act, amended the RBI Act, and went for for headline CPI as target. So the target, in fact, has been given by the government to the RBI. So that I don't think that RBI has any dispensation or any leeway to interpret the target in a way they see fit. So if they miss the inflation target for 3 consecutive quarters, if you remember, RBI has to write a letter to the government. That letter references to headline CPI, not really core CPI.
Thanks, Anurag, for taking up all these questions. On behalf of UTI Mutual Fund, I convey our sincere thanks to all the participants for viewing our webinar today and asking questions. Please share your feedback on the link provided. We look forward to connecting with you in our webinar coming for the equities. And post concluding remarks from Anurag, we can conclude today's webinar. Thank you and good day.
Thanks a lot, everyone, for joining in on the webinar. Hope you found the webinar useful. Please feel free to ask questions related to products or to any macro policy going ahead as well. We look forward to your participation. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.